Just 2 weeks ago, I made a video talking about how the first quarter of 2024 was a roller coaster for markets. All the major indices from S&P 500 to the QQQ and even Bitcoin were hitting an all-time high. This was not just constrained to the North American markets, this was the story all around the world. Of course, we also had some bad news, but overall it was pretty good. However, the new quarter is wasting no time in serving us some market-moving events. Barely 2 weeks into Q2, investors have had to digest a re-acceleration in the US inflation data, a tight labor market report reinforcing the Fed's hawkish view, and the kickoff to the crucial Q1 earnings season. On top of that, the highly anticipated Bitcoin halving is just around the corner. With so much happening already, Q2 is shaping up to be quite an eventful period for us. In this video, we'll go over the recent CPI report, the upcoming Bitcoin halving, the earnings season, and finally conclude with what I'm expecting to see for the rest of the year. Let's begin. Let's start with the recent US CPI report. Everybody was waiting to see what the March CPI data would say, mostly to see when the imminent pivot to interest rate cuts would come. The hopes for the imminent pivot to the interest rate cuts were dealt with a major blow as the March CPI data came in hotter than expected. There have been some unexpected re-acceleration in consumer prices. The headline inflation rose 0.4% month over month, keeping the annual figure elevated at 3.5% above expectations of 3.4%, and the largest 12-month increase in half a year. Core inflation, which strips out volatile food and energy, also ticked up 0.4% with the annual core rate at a lofty 3.8% now. And of course, Wall Street did not take kindly to this and we saw the stock market starting to tumble down. We saw the S&P 500, QQQ and even Bitcoin going down. Prior to the release, markets had priced in around a 50% chance of rate cuts as soon as June, but those bets were quickly unwound. The first rate reduction is now not fully priced in until September. There are even analysts who are suggesting that we may not see any rate cuts this year. There are some who are even suggesting further rate hikes. It all seems like a lot because for a lot of us we have never seen interest rates so high. However, if you look at some historical numbers, this is not that unprecedented. The markets can do pretty well with even high interest rates, as we have seen through 2023 and seeing in 2024 as well. But generally we know that the Fed is committed to restoring price stability even at the risk of tipping the economy into recession, which is very unlikely though. The latest jobs report showed that the labor market remains highly tight with unemployment rate dipping to 3.8% with continued payroll gains. This gives the Fed even more reasons to keep the interest rates higher for longer. Now I'm in Canada, so I'll spend a few seconds talking about the inflation and interest rates over here. In Canada, inflation has started to moderate but also remains stubbornly high. The annual CPI slowed to 2.8% in February, down from 2.9% in Jan, but still above Bank of Canada's 2% target range. The central bank has acknowledged these disinflationary trends in April and revised down its 2024 inflation outlook, now projecting price growth to an average around 2.5% in the second half of the year and returning to the 2% target by the end of 2025. This still gives them a lot of room to keep interest rates higher. We will definitely see interest rates come down, but don't expect them to come down a lot in a very short amount of time. Contrary to popular opinion, I believe that the Fed has done a pretty good job of handling the inflationary pressures. Even with such high interest rates, the economy has stayed resilient and still a soft landing seems to be the most probable outcome. I always thought the worst case situation would be a soft recession considering how strong the economy has stayed throughout this period. Anyway, let's see how the battle against inflation moves forward, but don't expect a lot of rate cuts this year, and if none of them come, don't be surprised either. Now, it's so close that we have to talk about the Bitcoin halving. One of the most highly anticipated events in the crypto world is just around the corner. The next Bitcoin halving is scheduled to occur around 20th April. That is in fact less than 10 days away. As you might know, this event is baked into Bitcoin's code and occurs every 4 years. But just as a refresher, what is the halving? It's a pre-programmed reduction in the number of new Bitcoin issued to miners as rewards for validating transactions on the blockchain. This time specifically, the mining reward gets cut in half from the current level of 6.25 Bitcoin per block down to just 3.125 Bitcoin. With the reduction in new issuance, the rate at which new Bitcoin enters circulation slows down significantly. From an economic perspective, a negative supply shock can lead to potentially higher prices if demand remains constant or increases. Basic laws of supply and demand would suggest that cutting the rate of new Bitcoin supply by 50% should exert upward pressure on the price over time. This is simply because Bitcoin will become more scarce relative to the number of buyers. Bitcoin has tended to rise significantly in the 12 to 18 month period following the previous halving events, potentially driven by this supply and demand dynamic playing out. The 2012 halving led to more than 8,000% rally in Bitcoin's price over the next year. The 2016 halving kicked off the major bull run that saw Bitcoin's price peak near $20,000 in December 2017. And in the 2020 cycle, Bitcoin surged to a new all-time high above 60,000 in the wake of that halving event. Of course, past performance is no guarantee of future results, and this time we have actually seen Bitcoin rise significantly before the halving event itself. There has been a wide range of price predictions this time, ranging from $100,000 all the way to $1 million. Now, it's great to hear crazy price predictions, but please don't get carried away. This time the cycle is definitely different, with a lot of new investors coming through the newly introduced Bitcoin ETFs. There are also a lot of institutional buyers coming into the market. That is exactly how we saw the price go from $30,000 to $74,000 in such a short amount of time. Honestly, at this point I'm expecting a little more pullback, or at least consolidation. Usually there is a quiet period before you feel the impact of the halving event. Anyway, we will be hearing a lot about this in the next 10 days because, as we said, the halving event is just around the corner. What else is around the corner is earnings season. As we kick off the Q1 2024 earnings season, investors will closely be watching corporate results and guidance for clues on the health of the economy and trajectory of profits. Last year was marked by stubbornly high inflation, aggressive interest rate hikes by the Fed, and lingering recession fears. This time we'll be watching the earnings mostly to gauge the business conditions. While inflation and recession fears seem to be coming down, as we know, the interest rates still remain pretty high. Let's see how this has been impacting all the businesses over the last quarter. Here are the three things that I'm looking for: elevated costs affecting margins, any supply chain constraints, and any softening of consumer demand. I'll be looking at three sectors carefully. Let me cover that, and then I'll go through some specific tech companies that I'll be looking out for. The first is the banking industry. The major US banks like JP Morgan, Wells Fargo, and Citigroup are expected to report mixed Q1 2024 results. The expectation is higher net interest income offsetting weaker loan growth and rising deposit costs. Overall, profitability is projected to decline amid economic uncertainty. The most important thing I'll be watching is the management commentary on the outlook and state of the economy and consumer health. The next important one is the consumer discretionary sector. This includes companies like Amazon, Nike, and Netflix. Overall, we want to see the consumer's appetite to keep spending in this economy. Any indications of consumer weakness or pullback could rattle markets further, but this would actually be good news for the Fed. Retailers and consumer brands have already been issuing profit warnings, with more potentially on the way as household budgets are squeezed. Finally, as you might have guessed, the third sector I'm watching is the tech industry. After a challenging 2023, tech companies have been slashing costs and headcounts to preserve profitability. Key areas of interest will be any signs of improving demand trends, the impacts of AI initiatives, and the outlook for capital spending given economic uncertainties. Guidance from Microsoft and Google's cloud business and Amazon Web Services will also be closely watched as a gauge for enterprise tech spending. Now, 2023 was rightly called the year of efficiency, and we also heard the word AI like a million times in every single earnings call. What we want to see in 2024 is how these cost cuttings have impacted the business and where is AI exactly heading. We now want to see the word AI translate into numbers and dollars. At a very general level, investors will be watching for any clues from the management of these companies on whether the much feared recession may have already arrived or if companies can continue navigating the current turmoil relatively unscathed. The guidance for the remaining of 2024 is going to be extremely important. Now I quickly want to cover a little bit about the companies I'm holding or I'm looking to buy. Starting with, we have Amazon. The key things that I'm looking for in Amazon are: first, the e-commerce growth and the Prime subscription trend amid cost pressures. Next, we also want to look at AWS cloud computing revenue and the market share they have gained. And finally, I'll be looking for any cost-cutting initiatives and operating margin improvements. Generally, Amazon will reveal a lot about consumer and business spending trends. The next one we have is Alphabet or Google. The first thing to look out for is the health of the digital advertising market and YouTube ad revenues. This is also an indication of how other businesses are doing. We also want to see their monetization progress for AI initiatives like Gemini. We all know how much they have fumbled AI in the last couple of months, so it'll be great to see some progress. We would also like to see the growth in their cloud business. Finally, we'll also be looking out for any cost savings. The next one is Microsoft, where we would like to see the Azure cloud revenue growth and the market share versus AWS. The next would be the demand trends for Microsoft Office and productivity software. Again, this shows us a general trend in the industry. And finally, we would like to see updates on the AI strategy and how their strategy is converting into dollars. The next one on the list is Tesla. We already know that their vehicle production and delivery numbers for Q1 2024 have not been good. Now what we want to see is their gross margin performance after so many price cuts. And finally, we would like to see any progress on the new factory ramps and product roadmap. This includes the Cybertruck and now their robotaxis as well. The next one is a company company that I have seen great returns on, and that's Palantir. As usual, we'll be looking for revenue growth from commercial versus government customer segments. We'll also be looking for profitability metrics like operating margins and cash flows. Finally, we'll also be looking for any updates on partnership expansions and new contract wins. The last company that I'm watching closely is Apple. The key things to look out for are iPhone sales performance and upgrade rates. We also want to look at their services revenue growth across segments like the App Store, music, and more. There are definitely some concerns when it comes to Apple, especially when it comes to their sales in China. There are also some other companies that I'm watching closely, such as PayPal, Robinhood, and Coinbase. I'm not going to go in depth right now, but we might cover them after the earnings. The final short segment of this video is about what I'm expecting for the markets going forward in 2024. I think Q2 might be a little bumpy going forward, but overall I'm quite optimistic about 2024. If the earnings are underwhelming, we might see stock prices go down briefly, but over the next 6 to 9 months, we'll definitely see them recover and go up to make new highs. Now, that is not a promise, that's just my belief and my thesis for investing in 2024. If you know Tom Lee of Fundstrat, he remains bullish, arguing that markets are underestimating the strength of the US economy, and I agree. In a recent note, Lee pointed to resilient consumer spending, a robust labor market, and the fading impacts of last year's shocks as factors that could drive markets higher over the remainder of 2024. He has actually been right since 2022, and I do believe that he is right this time as well. Another reason to believe that 2024 is going to be a great year for the stock market is the simple fact that 2024 is a US presidential election year. Historically, markets have tended to perform well in these cycles, with the S&P 500 averaging gains over 10% going back all the way to 1928. I have covered this topic extensively in one of my previous videos, feel free to check it out. In the video, I also covered why 2024 is going to be a great year for investors. So even though the short term might be bumpy, I'll be staying focused on the long term. I'll be buying any dips and any opportunities that come in front of me. Comment below if you agree or disagree with me. I'll see you next week with a new video. Till then, keep learning and stay on top of your finances. Until next time.